Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have Ed Cofrancesco, CEO of International Assets Advisory, to discuss why investing in equities is a marathon and not a sprint. Ed, it is great to see you. As always, welcome back to Trade Talks.
Well, good to see you, Jill.
Right. And Ed, you know what? We've gotten so used to instant gratification in the market that sometimes we forget that investing is an exercise in patience. Before we get into that, what are your thoughts overall as it relates to the macro?
I mean, when I look at the macro situation right now, I really want to be optimistic. I think a lot of us do. We've had a little bit of a mini rally at the end of last year and the first month of this year, but we've given some of that back. Last couple of days, we've gotten it back. We've gotten back some of what we lost, but we're still way down over the last 13 months, 14 months. And the macro situation is very, very confusing. You know, what pops into my head, of course, is the old Beatles song, Helter Skelter. It really seems like that. We're going around and around and come back, jump back up, and, and I'll see you again at the bottom and then at the top. And sideways markets over the long run, when we look at them throughout history, which is what we've basically been having, a lot of whipsawing back and forth, just are not a great indicator of positive things in the future. We still have a lot of inflation, a lot more than the Fed even realized. We have real threats of recession and trying to difficult land this into a soft landing, which a lot of us don't think can happen. We have so much geopolitical risk. There's just so much uncertainty out there that the macro is kind of scary.
I think another part of the challenge too, Ed, is the equity market seems to be saying one thing and the bond market is interpreting what the Fed's strategy is entirely something different.
Well, if I only looked at the equity markets in recent weeks, everything's great and it's smooth sailing. And if I look at bond markets, we're all going to die. Okay. So it's like you said, talk about, once again, helter skelter. I'm getting dizzy from all of it. And it's fun for a kid to go on a helter skelter slide. And it's great for aggressive day traders. But for long-term retail investors, we like a little bit more stability. So what we're seeing, we think that you need to be very cautious in these markets. We think that fixed income, particularly medium-term fixed income, looks good right now. But we also think there's some equities energy stocks. You should be in if you're not in energy stocks. As soon as you get done watching this show, get on the phone with your advisor, start talking about what energy stocks you like. We happen to like Chevron and Exxon a lot. And bank stocks with rising interest rates, and interest rates are going to continue to rise. Retail banks print money in a rising interest rate environment. So again, get on the phone with your advisor, start looking at JP Morgan, start looking at Bank of America and all the other big money center banks that have a big retail business. So we think those will be safe harbors. I'm sorry.
No. I was going to, ask you too, and I think this is just great overall advice that reminding investors that investing in equities is a marathon. Why is it important to remember that? I just feel like, especially younger investors, got so conditioned to the way the market moved over the past 12 to 14 years. And even though the market's sideways and there is some uncertainty there, really what we did see with stocks going from the bottom left to the top right of the chart, that was more of an anomaly versus, the traditional ebbs and flows of a market.
You're 100% correct. And especially if we're talking, let's talking to the viewers here that are 30 and 40 years old. Don't get so wrapped up in what the market's doing. Forget about day by day, week to week, month, quarter by quarter. Use your dollar cost averaging, invest over time, just consistently invest in incremental amounts because it's not your timing in the market. You try to time the market, you will get killed. It's your time in the market. It truly is a marathon, not a sprint. So, if you're 30 or 40 years old, don't get so wrapped up in these 1 month, 1 quarter, let alone daily moves. Be a long-term investor and you're going to be fine. Now you start to get to my age. Now you got to be a little bit more cognizant of what's happening. But in the same token, you get to my age, you shouldn't be as heavily invested in equities. We used to use that old rule of thumb, take your age minus 100. That's the percentage you should be invested in equities. Or maybe that's not 100% accurate, but it's still a good basis that you get to 60 or 70, maybe you shouldn't be 80 or 90% in equities.
Right. Well, there are some interesting equity opportunities out there. And you and I have spoken about this before. There are some companies, if you're looking for income, that are great balance sheets, great businesses, and they are consistent dividend payers. And in fact, many of them do raise their dividends on a consistent basis. So there are still other opportunities that are out there. I think it's important to think of that as you are getting 60s, 70s, 80s.
And you know, there's some ETFs right now that feel like they have a really good chance at getting 8, 9, maybe even up to 11% returns annually from the dividends. And if you're my age or older and you can get anywhere near 10% in dividends from, you know, solid performing companies, well, I think that's a pretty much a no-brainer. Take it. You know, you got to take that. That's solid type of returns. And again, people need to measure their expectations. You just said it. This isn't like that 12-year run we had where, you know, we just throw darts at the wall and things are going up 20%. 7 to 10% returns annually, I'm really happy with. That's really good. Remember the rule of 72, right? Take 72 divided by how many years? That's how long it's going to take you to double. If you can get 7.2% a year, you'll double your money every 10 years. Not a bad deal.
I'll take that deal too, Ed. Great to talk to you as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.